My name is Robin Hesselgesser, and I'd like to welcome you to the show. This show is really about creating change. So the people that you meet and the stories that you hear every week will hopefully empower and inspire you to make positive change in your life. So whether it's about your financial status or your career or relationships or just wanting to live your best life. Thank you for joining us. Once again, we have Tom Quinn, who is the president of Next Stage Financial. Tom, thank you for coming back with us today. It's so nice to talk to you some more. So today, I want to talk to you about wealth management more in detail. So I want to talk a little bit about if you could tell our viewers the top 5 things that Wall Street doesn't want us to know, what would they be? We're going in the deep end of the pool very quickly. I know.
I think the first thing is that it's, despite popular opinion and the impression that they foment, is that it's impossible to be truly diversified on Wall Street. So most of financial planning is a function of diversifying what you are saving and what you have saved to handle variations in the markets and other world events, right? So, but the problem is that on Wall Street, one secret Wall Street wouldn't want you to know is that, although it should be self-evident for most people, everything that you can buy from a Wall Street advisor is typically correlated. That means they're interconnected, right? Mm-hmm. So bonds and bond funds typically, they've said for years, will work in an inverse relationship or opposite direction of stocks and maybe most mutual funds. But just in 2008, where we had a massive market correction, 42% or more, right. Everything dropped simultaneously, so there was no safe haven, right? So it's a farce. So most of traditional financial planning is based on a lie, and that is it's not, you're not fully, everything's correlated, right? So here's the analogy. If you go to a State Farm or Allstate agent, you know, whether they tell you or not, typically if you're buying homeowners insurance or car insurance, that you're going to get a State Farm or Allstate product, right? Because they're captive agents or captive suppliers of their products. The unfortunate part is if you go to a Fidelity gal or a TD Ameritrade guy or Charles Schwab, they never quite come clean and tell you that they're really only allowed to talk to you about market-based securities, Wall Street-based securities that most people are familiar with. And so there's another secret, right? They typically won't talk about the things that are not on their grid, because there's a whole ecosystem on Wall Street of levels of, like if I can sell securities, I have to have FINRA licenses, and typically I would have a broker-dealer, and there's a food chain that makes money on fees that you know about, and then those fees that you don't know about.
Okay. And
so there's another secret Wall Street doesn't want you to know.
The fees.
The fees. And so fees can be massively wealth eroding to your family's financial success. And fee risk is a risk that most people don't understand. So they're the fees you know about. So let's say you and your family are saving in a qualified plan like a 401k, an IRA, a SEP, a 403b. There are the fees for the plan itself that range from typically 1% to 2% per year. And those only have to be disclosed because in most cases of federal legislation that passed just a few short years ago requiring that they be disclosed. Because Wall Street typically doesn't disclose anything negative unless they're absolutely required to do so.
Sure.
And then there's a whole set of other fees that, to use an example, Forbes reports that the average mutual fund owner, and many people own mutual funds in and outside of their 401k or their qualified plan or their market-based account, those mutual funds managers can charge on an average of 4.1% in fees, which are not required to be disclosed to the investor, whether it's in or outside of your retirement savings. So in many cases, you see your statements net of those fees. So there's another unfortunate secret that no one wants to come clean and tell you, right?
Wow.
So.
So what is the difference between your company, and those large brokerage houses? Because I think everybody is familiar with the Merrill Lynch and the Charles Schwab.
I think, so in addition to the types of investments, where our firm is focused on safe money, no market risk investments. And
is there such a thing?
There absolutely are multiple such investments. It's just they don't make as much money in many cases for the advisor or for the food chain that's developed in and around Wall Street. So they're not quote unquote securities. So, and it's difficult to hide fees in those investments. And so a lot of it stems from how most financial advisors get paid, and it's typically fees for funds under management, right? So if I get if my firm and I get 1 to 2% on your investment in retirement savings per year that you know about, and another 3 to 5% that we're not required to disclose to you, that could impact my advice to you, right? Because if you say, Tom, I'm worried about some news events or world events that might cause my savings to go down, maybe it makes sense to move to cash or some safer positions. Typical Wall Street advisors will say, no, Robin, you're in it for the long haul. This is a marathon, not a sprint, right? You don't want to knee-jerk react, right? You got to stay the course, right?
Right.
And so that's problematic because most financial advisors that get compensated that way, if you move to cash or a safe position like a money market, they can't charge you those exorbitant fees that you know about, and and more importantly, the ones that you don't know about during that time. So so that can color the advice that you get, unfortunately. And so, having gotten into this industry from another field, we talked about I was in the software industry before, and having been a customer both as a business owner and an individual on the other side of the table, I just looked differently at when I was trying to develop our practice and our focus at having been on the other side of the table, been around the block, right? So what we do differently is we have some investments that are truly uncorrelated, but they take a long time to describe, and then others that do some protection of the major risks that most people are facing, and that's taxation risk. So if your family's financial plan, whether you're a business owner or an individual, doesn't address insulating you from future taxation risk, you are headed towards a perfect financial storm in retirement. In addition to that, you must address fee risk. Then there's market risk, right? Like Harvard University in 2008 or 9 reported losing almost 30% of its $40+ billion portfolio in 1 year. So if they can't afford good wealth management advice on Wall Street, who can? Right?
Right.
So fee risk, and then the other risk is longevity risk, and that's a little bit more difficult to explain, but most people do whatever they do to save for retirement. Mm-hmm. They reach 65 or 70 or whatever their target retirement age is, and if you have a traditional Wall Street advisor, they have to ratchet down or reduce their risk coefficient, which is a technical term for how much risk you can be exposed to. And so if you're nearing retirement age, unless you're a bungee jumper and you're willing to sign a lot of forms that you take a lot of risks every day, most advisors are not allowed to expose you to those risks. So you tend to be relegated to investments that, while they might not lose money, they'll barely be able to keep up with inflation. Right? So you could be relegated to pedestrian returns for effectively a third of your life from 60 to 90 if you're blessed to live that long. just keeping up with inflation. So all the money you've saved doesn't do any growth, even though inflation is going up and costs of health care are skyrocketing for seniors and prescription drugs. So those are risks that's a latent risk that can pop up later in life and hurt you, right? Because you haven't planned for, people aren't thinking, oh, well, if I don't get a hold of my family's financial plan today, it could preclude me from using some of these investment strategies, which will safely enable me to grow some money during retirement, and that could be a third of your life.
Absolutely.
I can ramble on about this stuff.
That's okay. Well, I can tell you're passionate about it, and that's great. So it begs the question, if the traditional financial planners have made their money through fees, and obviously there's a direct correlation between their advice and the money that they make potentially, how do you get compensated?
There's really other two primary ways to get compensated. The second way you might get compensated is some advisors, some very specific type of advisors will charge a fee for their service, just like an architect. I'm going to design a building for you, it costs 25 grand, take it or leave it, 100 grand, and that may be the best way that might be theoretically the best way to charge fees for financial services. The challenge, though, is that people in the U.S. aren't used to, you don't know whether the advisors related to Bernie Madoff, are they really invested in your success? How good are they? Right. And do you want to pay all this money up front for a plan that might not work? So our firm typically gets paid in primarily a one-time commission with money that a client might redirect that they're already saving into one of our safe money, no market risk solutions, or reposition from other accounts they have. So primarily a one-time commission. So we're not in your pocket for the rest of your life, right? Providing what value, right? So if as an investor, I shoulder all the risk, I pay all the fees, but then Wall Street makes the same money whether they do a good job or bad job, and whether your money goes up or back. So that while there's no perfect way to get compensated, we've tried to do it in a way that makes more rational sense. So
yeah, well, and I certainly like the idea of having that one time versus forever, and helping that dictate what people do. You know, using myself as an example, when I was growing up, we didn't really talk about financial planning. My grandparents came through the Depression, and so their idea of financial planning was paying everything with cash. I remember my stepmother asking my grandparents one day, "Do you have life insurance?" And the reaction was, "No, everything's taken care of. You know, we've done all of that." I didn't ever feel comfortable broaching the subject of money up, you know, when I was growing up. And there isn't a class in school that, you know, teaches you the basics. And when I got into the corporate world, I did what everybody is taught to do. You have a savings account, and then because I worked for corporate America, they did offer a 401k, and they participated in that to a certain extent, right? So I'm sure a lot of our viewers are just like I was and thinking that that's the only option. That's what you're supposed to do. But you and I were talking a little bit about the history, and that fascinated me, and the evolution, and that there really are more options available to us that we don't even know about. So can you speak to that a little bit?
Absolutely, yeah. It's a difficult problem. There are a lot of dynamics there. You're right. In the absence of a better idea, people tend to follow the herd.
Right.
That's why most people, if they are saving for retirement, are doing it in a qualified plan like a 401k, IRA, or SEP, right? They may be saving other places. But 401ks and those types of qualified plans were never really intended to be a sole retirement solution. They really were designed to supplement, in some cases, pensions that companies were giving for years. But of course, business owners and company owners decided, hey, if we can promote this 401k where the employee does most of the savings, maybe we'll match a little, right? Then we can offload this tremendous responsibility of managing and paying for pensions. And so while it was never intended for that, it's kind of morphed into that, right? And of course, Wall Street loves it because what are most 401ks invested in? They're invested on Wall Street, typically in mutual funds and other securities on Wall Street. So that's what that has happened with 401ks. The other misperception a lot of people get, because they're really good at, most people are really good at what they do every day and they're focused on it. But there are these other dynamics that cause them to kind of follow the herd. One is maybe they dabbled in the stock market and they didn't do that well. Or they see shows, how do you know this guy or gal isn't related to Bernie Madoff? Or you see these American Greed shows, right? So there have been a lot of bad actors in the financial industry since money was invented, right? So they tend to be much more skeptical, and people kind of move in the avoidance of fear towards the herd mentality.
Right.
And then the other misperception is that there are very few, if any, employers that employers don't offer a 401k for their benefit, except it's really only to attract and retain new employees, right? So just like they feel they need to have a certain amount of health insurance and a certain amount of holidays and vacation time and whatever else companies offer in terms of benefits to their employees, if you're over 10 or 15 employees, there's pressure on you in most industries to offer a 401k or some retirement savings. Now, the other misconception people have is that most of those 401ks are not the company. I've started and run a few companies that got to a significant size. The employer rarely, if ever, pays a dime for the 401k. The 401k provides it, and all the fees that you know about, plus many that you don't know about, are charged to the participating employees in the 401k. So the misperception by a lot of people in different industries is that everyone's doing the 401k, that's what you should do, and the employer's kind of promoting it, even indirectly by endorsing it. So there's a lot of dynamics there.
So what should people do? Where should they start?
I think it starts with education and understanding. Most people, like you said, they avoid the discussion. Like you mentioned life insurance. So life insurance traditionally has been viewed as a death benefit only product,
right.
Something you buy for your loved ones. You don't get any benefit while you're alive. Well,
right.
There's lots of, part of our practice is we have some solutions that use life insurance that have lots of living benefits. It's not your father's Buick anymore, right? It's Oldsmobile. Sorry, it's not your father's or grandfather's life insurance anymore. So I think it starts with education, and there are more and more firms like ours that have identified these others. There's some other safe money, no market risk solutions that are not on Wall Street, right? And so, but it's difficult too because Wall Street controls all the lobbying groups. They control the SEC, FINRA. They've got big money to control inside the Beltway in Washington, D.C. So a lot of times, while it's not a conspiracy, it's an ecosystem, right? Because if you would hear me say this on CNBC or Squawk Box, then Scottrade, Ameritrade, Charles Schwab, and some of the other big players on Wall Street might say, hey, we're not going to send as many advertising dollars. So advertising-supported media, whether print, television, or otherwise, has some influencers by who's paying the bills. So while I don't believe it's a conspiracy, there is an ecosystem designed to support what most people think they should be doing, and that's loading money into qualified plans where there are tremendous risks there.
Well, I think there's a couple things at play, aren't there? For example, we are getting to the point where we're living much longer. We've had tremendous medical advances. so people are staying healthy. But there's that emotional barrier that we don't want to discuss our own mortality. We don't want to talk about getting older. That's a difficult thing to do. And I want to talk about somebody who maybe doesn't feel very good about their own particular situation. You know, maybe they've been through some things. Maybe life has spun them. Maybe they aren't where they thought they would be or should be, and maybe they're in their mid-50s and they're thinking it's too late. I think for those people, going to a financial advisor and going to get a prostate exam might be like this. It's scary, and maybe you don't want the news. Maybe that's just something you don't want to deal with. But I know for myself, what I tell my clients when they come to me about their life issues, I talk to them about it's not too late, and the past is gone, and all we can do is move forward from here. But in your line of work, what does that reality really look like?
Well, so past decisions you gotta try to move past. It's water under the bridge. A lot of people are dragging anchors from the past. There's hope. You just want to take action. It's far better at any age, to develop and execute your own plan rather than having Uncle Sam's plan executed upon you, right? And
that's a good point.
And so it doesn't have to be a scary process. There's some level of embarrassment maybe that you haven't saved so much, but as financial professionals, we see this all across the board, right? So the thing to do is just be honest, evaluate your situation, and develop a way to try to significantly improve your situation going forward. It doesn't pay to stick your head in the sand and procrastinate, especially with respect to financial planning and wealth management, because time is a factor, right, in most cases, because you're not just going to go buy a lottery ticket and hope to win tomorrow.
For people that are listening, can you or watching, can you talk about what that means? Can you talk to a specific example? If somebody comes to you, because you really do have a unique mix. You have this wonderful software ability. I mean, I can tell that's where you started. Your ability to create that and mix that with options is just fascinating to me. So can you illustrate a specific example that you've helped someone, and what those advantages or differences have looked like, and the choices that they might not have known they have?
Absolutely, yeah. I can think of a couple that I worked with recently this year. They're 45, 46-year-old couple, Robin and Jeff. They're doing all the traditional things. They're trying to pay off and pay down their house as quickly as possible. They're both working. They've got a couple kids. They're saving for retirement in their respective companies' 401ks. And so the numbers off the top of my head, I think between the two of them, they were saving like $26,000, $27,000 a year in their qualified plan. So they're good savers for a 45-year-old couple, and they had accumulated some money in their 401ks, and not realizing that there are lots of perils with a 401k, right? They're postponing both the tax and the tax calculation, right? So when you put money in a qualified plan, you've agreed, whether knowingly or unknowingly, to postpone both the tax and the tax calculation to a future time when Uncle Sam can change the tax rates at any time, right? And there are almost 20 states now that charge income tax on qualified plan distributions. So not only might you have Uncle Sam as your unintended and uninvited partner in retirement, but you could have the state you happen to retire to or live in when you retire. So that's a misperception most people have. And they're also exposed to the things we talked about earlier: market risk, fee risk, in addition to the taxation risk and longevity risk. So here's a couple. All we did was redirect what they were already saving, because they were saving what they could, into one of our safe money, no market risk solutions. And the difference was staggering. They were running out of money at age like 73 or 4 with their current plan, even with the rosiest possible future projections. This plan helped them take the same amount of after-tax income up to age 100, should they be blessed to live that long. Mm-hmm. And the difference at age 75 was like $1.4 million. So it was a $1.4 million mistake to continue doing what they were doing with their 401k versus our plan, close to $1.9 million at age 80 and $2.3+ million should they be blessed to live to age 85. So,
wow, that's huge.
Well, that's not every case, and that's just a 45-year-old
sure.
Couple. In this case, we help people in all ranges up to 75 years old, 80 years old, on down. We've got different solutions, but that's an example that comes to mind that of folks we've helped recently.
Okay. Well, Tom, in closing, can you talk to our viewers about what they should do if they want more information? Where can they go? Obviously, it'll be on my website, www.robinjhusselgesser.com. I'll have a link to your website as well, but would you like to tell our viewers how to get started and how to find out more information from you?
Yeah, what we're offering to your viewers is a free complimentary consultation, web-based, if that's more comfortable, or in person. And there's no selling, it's all education, right? And we'll do a free retirement ready or not analysis for everyone. And people just love this retirement ready or not analysis that we do. And ideas are free. No one's got a monopoly on all the good ideas. Even if you have a guy or a gal already a financial planner, isn't your family's financial security worth getting a second opinion?
I think so.
Right? And so they would go to the website www.nextstagefinancial.com, and there they can schedule a time and request a complimentary consultation.
Okay. Thank you, Tom. Again, we appreciate you being here today, and we hope to have you back very soon.
My pleasure.
This is Robin Husselgesser. Thank you for joining us today. Next week, we hope to inspire and empower you to make an even better change in your life. See you next week.